PLTR stock and SOFI stock analysis, why investors are going all in on these growth stocks. Hey there fellow investors and tech enthusiasts, welcome back to another exciting episode of our YouTube channel. Today, we'll be delving into the analysis of two articles. The first one bears the title Palantir, I'm going all in, and following that, we'll dissect another piece about SOFI Technologies, labeled this one meme stock has legitimate long-term upside. Our examination will encompass the latest news updates, upcoming catalysts, price targets, and potential future trajectories of Palantir Technologies and SOFI Technologies concerning their share prices. To stay updated on Palantir Technologies or SOFI Technologies and for more content, be sure to engage with the video by liking it, share your thoughts in the comments section, subscribe if you're new, and consider becoming a channel member for as little as 99 cents per month, as your support is instrumental in keeping me on YouTube. With that said, let's dive straight into today's stories, commencing with the article titled Palantir, I'm going all in. A cautionary note is immediately sounded, advising against going all in on a single risky growth company. This is deemed improper risk management, and the speaker expresses disbelief at financial reporters who would endorse such a strategy, emphasizing the importance of proper risk management for steady and safe wealth building. The speaker introduces a risk management policy advocating not investing more than a 5% initial portfolio allocation into any single risky growth company, including Palantir Technologies. Using a hypothetical scenario, the speaker illustrates that if a portfolio is valued at $100,000 and one intends to invest in Palantir Technologies, the suggested amount is $5,000. This investment can be executed as a lump sum or through dollar cost averaging, a method the speaker personally prefers. Dollar cost averaging involves spreading the $5,000 over several weeks or months, establishing a competitive average cost basis based on the stock's average investing price. Despite the 5% allocation guideline, the speaker acknowledges that if Palantir surpasses this threshold and constitutes 10% of the portfolio, it's acceptable. The key is to commit to holding the investment for the long term, with the flexibility to take profits periodically and reinvest strategically. The speaker stresses the importance of diversification, advocating for a portfolio consisting of multiple outstanding companies to enhance safety, resilience, and overall profitability, expressing strong opposition to going all in on any singular stock, especially one as volatile as Palantir Technologies. The speaker discloses a personal affinity for Palantir Technologies and the inclusion of it in their portfolio. Palantir Technologies is introduced as a big data and analytics company serving commercial enterprises and government clients, specializing in artificial intelligence and machine learning. The current PLTR share price is mentioned at $19.60 per share, with bullish projections suggesting a potential surge to $25 over the next 12 months. The speaker expresses a belief in the company's potential for an even higher valuation. Nonetheless, a downturn is looming for Palantir, and I'll explain why shortly. First, let's address the overly optimistic stance presented in the article. While I appreciate the enthusiasm of investors going all in on Palantir, such a strategy amounts to improper risk management. Relying on a single stock to constitute 100% of your portfolio exposes you to unnecessary risks. It's wiser to have exposure to Palantir alongside other solid stocks like Alphabet, Amazon, Apple, Microsoft, and Berkshire Hathaway. Now, let's delve into the reasons behind the author's bullish outlook on Palantir Technologies. The recent surge in PLTR stock can be attributed to the outstanding Q3 results and impressive Q4 guidance, fueling excitement about the company's growth prospects. Despite the high accounting multiples Palantir currently trades at, signaling an expensive valuation compared to market averages, the author believes in the company's continuous growth. Ideally, lower multiples would be preferable to ensure a good stock price. Investing in Palantir at the current high share price raises your average cost basis, which may not be beneficial in the long term. The goal is to acquire the stock at a lower price, presenting an opportunity once Palantir experiences a pullback. Palantir's exceptional performance has driven its stock to a new 52-week high, with various factors indicating the potential for even higher prices based on current momentum. However, the anticipated major pullback is not a question of if but when. This inevitable downturn will offer the best buying opportunity. Therefore, the recommended strategy is to hold and observe the portfolio value rise as Palantir appreciates. Subsequently, taking advantage of the pullback by purchasing more shares at a lower price is the prudent approach to investing. The author emphasizes the importance of practicing proper risk management, with a reminder that Palantir should not constitute more than a 5% initial portfolio allocation. In the upcoming year, the author plans to showcase their YouTube portfolio, emphasizing consistent profits and gains. Returning to the discussion on Palantir, the company has garnered optimism from investors due to its artificial intelligence platform. Launched earlier this year, the AIP platform has attracted 300 major clients, predominantly from the S&P 500. Palantir's involvement in aiding Ukraine against Russia and collaborating with Israel in countering Hamas has added to its positive image. The AIP platform, used in both military and commercial sectors, showcases Palantir's potential for growth, with plans for IP boot camps for over 140 organizations. Despite the company's current high accounting ratios and multiples, a pullback is awaited, as suggested by a recent DCF model estimating Palantir's fair value at $16.05 per share. The author advises waiting for this pullback to make long-term gains, considering Seeking Alpha's quant system grades Palantir with a D for valuation. In conclusion, while Palantir has significant growth potential and has received accolades for its AIP platform, waiting for a pullback is advised for a more favorable entry point. The bullish momentum should not overshadow the importance of proper risk management and portfolio diversification. The author rejects the notion of going all in on Palantir and highlights the risk associated with such a strategy, likening it to gambling rather than investing. This cautious approach aligns with the belief that buying on weakness, especially during a pullback, is key to successful long-term investments. Certainly, I understand your interest in Palantir. The detailed analysis highlights the positive aspects of the company, particularly its artificial intelligence platform, which has garnered attention and optimism from investors. The AIP's application in military contexts, such as assisting Ukraine against Russia and collaborating with Israel against Hamas, showcases its real-world impact, saving lives and improving efficiency. Palantir's commercial sector involvement, conducting AIP boot camps for organizations, adds to its growth potential. Despite the impressive aspects, the analysis advises caution due to the current high accounting ratios and multiples. The recommendation is to wait for a pullback before considering further investment. The fair value estimates, including the recent DCF model suggesting $16.05 per share, indicate the importance of acquiring Palantir shares at a favorable price for long-term gains. While acknowledging the bullish projections, the analysis emphasizes the need for a balanced approach, avoiding the fear of missing out and waiting for the right entry point. The analysis of SOFI Technologies provides a comprehensive overview of the company's strengths and growth prospects. The focus on its digital-first approach, targeting young high earners through its app-based financial services, showcases its resilience and potential for substantial upside. The absence of physical branches distinguishes SOFI from traditional banks, eliminating associated expenses and attracting a tech-savvy customer base. The financial performance, particularly the significant increase in revenue and members in the recent quarter, reflects the company's impressive growth trajectory. Surviving and thriving during the regional banking crisis underscores its resilience and ability to capitalize on market opportunities. Despite the observed net loss, the analysis clarifies that it resulted from a one-time non-cash impairment of goodwill, not indicative of ongoing financial challenges. The anticipation of SOFI becoming GAAP profitable in the current quarter adds to its appeal as a better buying opportunity and a safer long-term investment. The comparison of SOFI's multiples, such as the price-to-sales ratio, with other companies like Palantir Technologies, highlights its attractiveness from a valuation perspective. The emphasis on the company being 74% below its all-time high suggests potential for future growth, aligning with current growth projections. In summary, the analysis presents SOFI Technologies as a strong and resilient company with significant growth potential. The discussion of risk management, pullbacks, and proper investment practices adds a prudent perspective for potential investors. The contrast with Palantir emphasizes the need for a nuanced approach to investing based on the specific characteristics of each company. And that's it. We hope you enjoyed this video. Don't forget to hit like and subscribe to our channel for more updates. Thank you for joining us in this video, and we hope to see you in the next one. Happy investing!